When you retire, you leave behind many things, but one thing you keep is a tax bill. In fact, income taxes can be your single largest expense in retirement. Let's go over 3 types of taxed retirement incomes. Taxation of Social Security benefits. Many older Americans are surprised to learn that they might have to pay tax on part of the Social Security income they receive. Whether you have to pay such taxes will depend on how much overall retirement income you and your spouse receive, and whether you file joint or separate tax returns. Generally, the higher that total income amount, the greater the taxable part of your benefits. This can range from 50 to 85% depending on your income. There is no tax break at all if you're married and file separate returns. Taxes on pension income. You have to pay income tax on your pension and other withdrawals from any tax-deferred investments, such as traditional IRAs, 401ks, 403bs, and similar retirement plans, and tax-deferred annuities. In the year you take the money, the taxes that are due reduce the amount you have left to spend. You will owe federal income tax at your regular rate as you receive the money from pension annuities and periodic pension payments. But if you take a direct lump sum payout from your pension instead, you must pay the total tax due when you file your return for the year you received the money. In either case, your employer will withhold taxes as the payments are made. So at least some of what's due will have been prepaid. If you transfer a lump sum directly to an IRA, taxes will be deferred until you start withdrawing funds. Taxes on IRAs and 401ks. Once you start taking out income from a traditional IRA, you owe tax on the earnings portion of those withdrawals at your regular income tax rate. If you deducted any portion of your contributions, you'll owe tax on the same rate on the full amount of each withdrawal. You can find instructions for calculating what you owe in IRS Publication 590, Individual Retirement Arrangements. If you have a Roth IRA, you'll pay no tax at all on your earnings as they accumulate or when you withdraw following the rules. But you must have the account for at least 5 years before you qualify for tax-free provisions on earnings and interest. When you receive income from your traditional 401k, 403b, or 457 salary reduction plans, you'll owe income tax on those accounts. This income, which is produced by the combination of your contributions, any employer contributions, and earnings on the contributions, is taxed at your regular ordinary rate. Keep in mind that withdrawals of contributions and earnings from Roth 401k accounts are not taxed provided the withdrawal meets IRS requirements.